By now, everyone has already heard of crypto. It's becoming more famous, and we cannot ignore it anymore. But what on earth is a cryptocurrency, and how does it work? Let's find out. In order to do that, let's have a quick rundown of the different stages of currency. Stage 1. In early societies, trade was based on bartering goods. You'd negotiate directly, like trading an orange for an apple. This was also limited by personal needs. Stage 2 introduced coins made of precious metals like gold and silver. These coins were universally accepted as valuable, enabling easier trade regardless of personal preferences. Stage 3 saw the rise of paper money backed by government trust, replacing the need for carrying precious metals. This transition made transactions more convenient and standardized, like modern banknotes. Stage 4. Today, digital entries in bank accounts and transactions online define our money. It's no longer about physical coins or notes, but digital records on spreadsheets. And Stage 5. Cryptocurrency takes this further. It's entirely virtual, based on blockchain technology. Unlike traditional currencies, it lacks physical forms like gold or paper. It's purely digital assets being exchanged. Now that we have a rough idea about cryptocurrency in general, let's move on to how cryptocurrencies operate. Cryptocurrencies operate on a decentralized ledger system. Instead of multiple banks keeping separate records, there's one massive spreadsheet, known as a ledger, that records every transaction of a cryptocurrency. The charm of cryptocurrencies lies in their decentralized nature. Each transaction is recorded on the same ledger, maintained by many copies worldwide through a process called mining. Miners use computer power to verify transactions and are rewarded with cryptocurrency. This decentralized ledger system ensures security and prevents fraud. With numerous copies of the ledger, any attempt to alter transaction records is easily detectable, making transactions transparent and traceable. Cryptocurrencies offer benefits like quick international payments without banks. Transactions are nearly instant, with minimal to no transaction fees, and without concerns about exchange rates or interest rates. Now you may wonder, why are they even called cryptocurrencies in the first place? Cryptocurrencies derive their name from cryptography, which ensures their security. Blockchain, a technology used by major cryptocurrencies like Bitcoin, is not a currency itself but a secure type of ledger. It organizes transaction records into blocks, each containing transaction details, a unique identifier or hash, and a link to the previous block. The security of blockchain lies in its structure. Any change to a block alters its hash, invalidating subsequent blocks. Since each user in the network holds a copy of the blockchain ledger, altering a transaction on one block would require changing every subsequent block across a vast network of computers, thus making fraud extremely difficult. Cryptocurrencies have problems too, but we'll talk about them in a minute. For now, let's quickly cover how investing in crypto generally works. Investing in cryptocurrencies involves exchanging traditional currencies like dollars for digital assets such as Bitcoin, with the hope that these cryptocurrencies will increase significantly in value or go to the moon. There are over 4,000 different cryptocurrencies, each with unique characteristics. For example, Ethereum processes transactions faster than Bitcoin, Cardano is known for its advanced technology, and Litecoin features a newer algorithm. One famous investment strategy is called diversification. Investors allocate funds across various cryptocurrencies. For example, $40 in Ethereum, $20 in Polygon, $20 in Cardano, $10 in Cartesi, and $10 in Litecoin. This isn't financial advice, but it's generally recommended that you make modest investments in assets you are prepared to handle fluctuations with. Now that we've covered that, it's time to look into the problems with cryptocurrencies. One reason cryptocurrencies aren't taken seriously by some is their volatility. Being relatively new and entirely digital, their values are speculative and heavily influenced by news cycles. Positive news can spike prices, while negative events, such as tweets from figures like Elon Musk, can cause significant drops. Another issue is the inconsistent acceptance of cryptocurrencies as payment. While some businesses like Microsoft and Tesla have shown interest, many others have hesitated or reversed their decisions, creating uncertainty about their practical use. Environmental concerns also surround cryptocurrencies due to the massive energy consumption required for transaction verification across numerous computers. Critics argue this inefficiency contrasts with the move towards renewable energy sources, though others point out advancements in technology and comparisons with traditional banking's energy use. On a darker note, the perception that cryptocurrencies facilitate criminal activities still persists, despite evidence suggesting otherwise. Cryptocurrency transactions are pseudonymous, not anonymous, meaning they can be traced through public keys on the blockchain. In contrast, cash transactions are inherently untraceable, making them more favorable for illicit activities. Aside from all of these, there are odd things that we'll talk about cryptocurrencies. Cryptocurrency has also led to some unconventional developments, like non-fungible tokens or NFTs. These tokens allow digital ownership of items, such as JPEG images, verified through blockchain. Despite not preventing others from using or copying the digital asset, owning an NFT establishes ownership of the original piece. Some find NFTs perplexing because purchasing one doesn't grant rights over the item itself, unlike traditional ownership. Instead, it merely proves ownership through blockchain, which some still value highly. For instance, an NFT of a digital art piece sold for $69 million just for the proof of ownership. Dogecoin, initially created as a joke based on Litecoin's technology, gained unexpected popularity and value. Despite its humorous origins, early investors in Dogecoin saw its value soar, turning some into millionaires. You can never truly know what's going to happen next. Whether you're a believer or not, we can all agree that it's an interesting topic. So, what do you think? Is crypto going to be bigger in the near future? What impact might widespread adoption of cryptocurrencies have on traditional banking systems? We would love to hear from you. Please share your wonderful thoughts in the comments below. Also, if you found today's video informative and would like to receive more insights and updates on cryptocurrency and global finance, please consider liking the video, subscribing to our channel, and turning on post notifications. Stay tuned for our next episode, where we'll bring you more of the latest updates in crypto and digital finance. Until then, keep questioning, keep exploring, and most importantly, continue to invest wisely. Thank you for watching, and we look forward to seeing you in the next video.